Pleased to welcome CPA Ryan Lane from the Bonadio Group to the program. Great to have you in. Welcome.
Thanks. It's good to be here.
So our topic is required minimum distributions. We're talking about folks that have reached retirement age, specifically 70 and a half years. Let's begin by defining what required minimum distributions are.
Sure. If you have a retirement account and you reach the age of 70 and a half, there's a required amount of money that you need to withdraw from those accounts each year.
All right, what kind of accounts are we talking about here?
Typically, you're talking about employer-sponsored accounts, such as 401ks, also traditional IRAs, and IRA-based accounts, such as a simple IRA.
What's the required amount? How much should people be taking out here?
So that is determined by taking your balance as of December 31st of last year for your accounts and dividing it by an amount, life expectancy amount provided by an IRS table.
Okay, and then so that's when you calculate it, December 31st. When do you have to take it out by?
You have to take it out by December 31st each year, except for if you have an IRA and you turn 70 and a half. That year you're allowed to take it by April 1st of the next year.
Okay, so you get a little bit extra time with an IRA.
You do.
All right, let's talk about taxation here. How are they taxed, these distributions?
Absolutely. Except for the amounts that have already been taxed previously, they'll be included in your ordinary income, similar to as if they were wages.
I'm going to throw a little curveball in here. You can offset that tax burden here, potentially, right? How do we go about that?
So you used to be able to take, and you still can take charitable contributions if you itemize. Now that the standard deduction has increased, you're finding less people are able to take that. So you can offset your required minimum distributions by taking a particular amount from your IRA and giving it to a charitable organization, and that will count towards your RMD.
All right, that's good to know. That's good to keep in mind here. What happens if somebody misses the deadline, they don't take the RMD? What happens here? So
if you don't take it by the required deadline or you don't take the full amount, the amount that's left in the account is going to be taxed at 50%.
That is a large number, 50%.
It's very large.
And no one wants that.
No.
What if you do miss it? Is there any recourse to try to avoid that huge penalty?
You can appeal it to the IRS if you can show a reasonable cause for missing the deadline. That will require filing an additional form and a letter of explanation with the IRS.
Okay. Final thought here. If folks are reaching this age, they've heard what we've said, but they're just a little fuzzy on the details. What's a good step in that situation?
Any certified public accountant would be a great resource for any retirement need.
Okay. We'll leave it there, Ryan. Thank you. Appreciate it. If you missed any of our conversation, as always, we'll share it online as well. You'll find it at rochesterfirst.com.